Well, good afternoon, everybody, and welcome to Close of Business Tuesday. We got a whopper today. I always say it, and it's always true. We've got our good friend, Al Carnwright. Al is with the Carnwright Group. He's the founder, and you'll hear a lot about what they do, but in a nutshell, they are advising executives all over the world around anything and everything related to energy company strategies, costs, the energy transition, everything that's happening in energy. Al and his team at the Carnwright Group are helping people with. And so Al's also just a good friend, and we've known him for quite a while and have loved all our interactions. So welcome, Al. It's great to have you.
Thank you, Maynard. Appreciate being here. It's going to be a fun session.
Yes, sir. Well, we've already had a lot of fun in the pregame. You guys don't know that at home, but we can't wait to visit with Al. Mike, what's happening on the screen? We were reflecting that the history of Close of Business Tuesday is that the first time we tried to shoot it, it was a Monday, and the Monday was so red on the screen, we waited till Tuesday. We got that pattern going again. Yesterday was pretty ugly. What's happening?
Yeah, Maynard, I remember those days. That was ugly, and yesterday kind of felt just as ugly, but it's been kind of a wild 4 or 5 days for crude oil and energy equities. Kind of liking it. What's going on right now is just follow the 10-year yield curve, and you'll understand what's going on with crude oil. 5 days ago, the 10-year was at 1.4, and WTI was at 74. 2 days ago, the 10-year had fallen to 1.3. WTI fell to 71, 72. And then yesterday, the 10-year plunged from 1.3 to as low as 1.17, and that pulled crude down to as low as $66 a barrel, which was below the 50-day moving average that I hadn't seen for 3 or 4 months of like 69.50. And today we kind of started the day at 1.17, rallied to 1.21. Everyone was feeling good. It was carrying TI higher, and then it reversed course early in the morning and plunged down to 1.12, and it took crude along with it. And so right now the 10-year has rallied back to a little over 1.20. Crude oil's back above the $66 100-day moving average, and it's around 67.50 a barrel. So, and the screen is lit up and it's nice and green. And so I guess what we would say is that what's driving the market right now has nothing to do with OPEC. We saw OPEC over the weekend, decide to add 400,000 barrels of supply. That wasn't the culprit. The culprit is this whole COVID variant strain. He's getting people concerned. It's a big fear factor. It's a big risk-off trade, and people are concerned that we're going to have to shut down the economy again. And so, to us, I don't think that's going to happen at all. It's really, really so much fear right now. It's really interesting to me that these fears are really coming at the same time that, people are trying to get through budget proposals that have seem to be getting pushed to the sidelines. So it's very cleverly convenient for the headlines to really start pushing this narrative. And so the last thing that we tell our clients, it's easy to tell them just buy, when things are going down. But you know what? You need to see a stabilization in the yield curve, and we're seeing a little bit of that today. Let's see if it holds. But that's really going to tell you what people's expectations are for demand. So the last thing I'd say is we think the variant fears are overblown. We don't think we're going to see world economy shut down again because consumers are just not going to allow that to happen. And so what we have right now in crude and equity markets is, crude oil, we think normalized price for most people is around $60 per barrel. And a lot of these equities are priced in sub $50 a barrel crude oil. So we think there's good value. There's no reason to be rushing in, and going crazy right now, but you should definitely be tiptoeing in the market at this point because, look, what we saw with the, investors and long-term investors in particular is they were not willing to buy energy equities with crude above $70. They feel that's over, it's higher than normalized. We're now well below that, and I think we're going to start to see some generalists coming. Hedge funds are going to start to come in. You don't have to go crazy, but it's time to be buying, not selling.
Well, I'm with you, Mike. I'm not ready for lockdowns. We can't do it. Colin, what do you think? What's going on with you today?
I'm going to pick up the baton where Mike just left it off. The house view, at least on the banking side, has been this is not really a surprise. We've had a lot of warning signals building over the past 2 or 3 months. Mike and I have gone through them, and it really is all about the yield curve, all about treasuries. And even when you overlay some of the equity indices, it's a pretty strong match. And so it raises the question of, well, what is moving the 10-year around? And so let me just show you a couple of charts. If you look at Google Trend data and type in Delta variant, you can see nobody was searching for the Delta strain before June 1st. And then as we went from June into July, there was a lot of interest. Now, I give here 3 different search terms: Delta variant, variant Delta COVID. That's probably people more like me and Mike just trying to get data. This is what's interesting: Delta variant COVID symptoms. That's what you would type in if you actually had symptoms. And notice that now it's the one that is most, keyed into what people are actually searching for. So the first point is it's people who actually have symptoms that are doing these searches, as opposed to analysts like me and Mike. And you can see that there's just been this very strong uplift of the 10-year yield as that particular search term is at 100% of its own, trailing numbers. Then when we look at the reported data on cases and deaths, you can see here on the left, the United States, on the right, world ex-US. It is quite clear that a 5th wave is here, and Bloomberg is reporting 83% of new cases are this Delta variant. So there is a legitimate pickup, a legitimate increase in the data. As of July 19th, the 7-day moving average for daily new cases is just under 35,000. In the US, that's up from 15,000 just 10 days ago. And unfortunately, mortality, fatalities are also increasing. They're now at 263 per day on the 7-day moving average, up from 185. And you can see over here, same kind of story for the world ex-US, a 5th wave in the world. And again, this is just reported, confirmed data. I think, we all know India, Myanmar, Vietnam, Brazil do have material case counts even beyond what's been confirmed. And you can see there the data, world ex-US. But let's go back to this table that we've shown a few times in the past. It's our COVID math table for herd immunity. And we just make a couple of points. The first is, while the headlines would report that 56% of the US population has at least 1 dose and about 49% are fully vaccinated, let's not forget that you can only get a vaccine if you're 12 years old or older. So the first calculation you have to do is to know that 85% of the 332 million Americans are in that cohort, or about 284 million. And so the actual numbers for folks who can get a vaccine are about 10 percentage points higher than what you'll read in the daily newspaper. About 2/3 of US adults, defined as 12 and older, have received at least 1 dose, and about 57% are fully vaccinated. And then a second point we've made before too is, of course, it's not just the vaccinated, it's folks who have natural immunity or have had a case, whether that is documented or not. And we know that confirmed cases are about 10% of the US population, 34 million and change, according to Johns Hopkins. We estimate that the undocumented cases are about 15%. Admittedly, as testing has improved, this number is getting more and more sticky. So most of these cases would be from early in the pandemic. But the takeaway point is that 82% of the total US population has either had at least 1 dose of a vaccine, has some version of immunity, or has had a case. That's our best guess. And then the percentage of US adults, assuming that there is a pro rata distribution of cases from this 12 years old and over, for the documented and undocumented cases, would suggest about 92% of US adults have encountered this virus. And remember, 15 percentage points of the population are not able to get the vaccine. So to have about 18% of the total US population not partially or fully immune is pretty much bumping up against a mathematical capacity constraint. And then one other point, we're still seeing about 500,000 doses per day. And so even if nobody had a new case going forward, if we maintain something like 500,000 doses per day, we would have 90% of the total population partially or fully immune within 50 days. So all of that is to say, this is where, as Mike said, you got to be a little bit careful. You can have people genuinely worried, typing in Google search terms, and to be sure there is a case and there is a rising trend. But when you have these capacity constraints, you got to be careful that you don't overextend the perception of risk. And so there, it's important to know what's actually happening in the physical market. Here on the left-hand side, we have China's crude runs expressed as a utilization rate at the independent oil refineries in Shandong. You can see that lately the trend has been down for runs, admittedly from a high back towards the normal range. We see a similar pattern in the United States where we had a big bounce in utilization after Winter Storm Uri, got back to normal levels on the 2011 to 2019 average. And in the past 3 weeks, we've been drifting lower, even though 92% is obviously a very nice utilization rate. When we were in June, China's total crude runs, the state champions plus the independents, were at 14.86 million barrels per day. That's a new all-time high. So into June, we had strong demand. Now it's beginning to wane on the margin. Similarly with the United States, 16.09 million barrels per day, according to the EIA last week, still a strong number, weakening on the margin as that supply comes in. And we've shown this chart too in the past, but just to give the update, as China's domestic crude oil balance has moved from parity, from basically zero, to a deficit, a chronic structural deficit that is now north of 10 million barrels per day, it needs to fill that gap with imports. And so it's important to know that as price has increased, and here you can see in this line graph, the Brent oil price, we see less interest from the Chinese to import. And so let me just quickly end on this from the fundamental standpoint. When we got to 2018 and we saw the big drop in crude post the Khashoggi incident and the Mexican sovereign hedge moving through the market, we saw the Chinese importers respond to a better price by taking in above average imports. Similarly, when we went into the COVID experience and the price got down famously to the sub-zero print in TI in April 2020 and a Brent average monthly price of $26.63, we saw a huge increase in orders so that by June 2020, allowing for the lag between price and actual importation into China, we saw 2.4 million barrels per day above trend. In the past 3 months, we've seen a pullback by the Chinese, less interest in importing. They've been destocking. To put some specific numbers on it, January 1, 2020 through the end of the first quarter this year, the average Brent spot price was about $46 and change. We saw 471 million barrels of builds in crude in China. That's the equivalent of about 32 days against June 21 runs. In the last 3 months, the average Brent spot price has been $69. We've seen a draw of about 56 million barrels, 3.8 days. Totally rational, reasonable behavior, and part of the reason why you've seen oil traders get increasingly bearish on the margin when we had the price above 70 on both Brent and TI. And then finally, today we had Jeff Bezos do his Blue Origin flight. A lot of people have been waiting for this, and thankfully it went off without a hitch. After the flight, he held a press conference and he announced a Courage and Civility Award to recognize leaders who aim high, pursue solutions with courage, and always do so with civility. And he said in the conference, he wants to recognize those folks who are really focused on solutions as opposed to ad hominem attacks. His quote was, he's for unifiers, not vilifiers. And he's going to give $100 million for charitable causes to be allocated at the sole discretion of the recipient, no strings attached. The first recipients were Van Jones and Jose Andres. So I'm going to give the thumbs up there from Close of Business. We like that emphasis on civility and this idea that we're all in this together and we can have disagreements, but we're all trying to move forward toward a better world. And Maynard, I'll turn it back to you.
That's awesome. I love that. Well, and we got a little more space in there now, two space shows in a row, so to speak. Can I ask you guys just one question, just so we're all see if we're all thinking about it correctly? This, Mike, what you were going through, and Colin, you talked about it too. U.S. Treasury yields and oil prices, are they both just proxies for the global economy? And, when the economy is roaring, you're less interested in owning treasuries and yields go up and oil prices go up. So is your comment for all of us watching at home that they respond to the same forces or that they actually influence each other? What's the right way to think about that relationship?
Well, it's both. So the bond market is discounting growth and inflation expectations, and there's no more important market out of all markets than U.S. Treasuries. It is the source rock for all other prices, and it hasn't really moved around a lot in recent years with zero interest rate policy, and it can be the not as exciting market if you're used to equities. But what's happened here, of course, is you had the market get a little bit distracted by this whole question of whether inflation is transitory, as if you couldn't have transitory and more durable inflation pressures at the same time. And so what's happened in the bond market is that CPI numbers, PPI, all sorts of inflation expectations have been way stronger than even the inflation bulls have said. And so that has pulled forward expectations that you may get, or not, but may get a rate hike from the Federal Reserve and others sooner than expected. And if that happens, you have to adjust your growth expectations. Then you layer on top of that, the inflation bear has to admit they were wrong. There is inflation that is not in dispute anymore. And yet we also now have this new Delta variant, which was not expected in March or April. And so you have to acknowledge that the growth side has changed too. Then throw on top of that the inflationary pressures gave you a 7 handle on crude and possibly heading to 8, particularly if you left the OPEC supply off the market, and you have to reprice everything. And then and Mike made this point, when you get down to a 50-day or 100-day moving average, as happened yesterday in the 10-year market, that is going to trigger both human behavior in response and, importantly, also algorithmic trading. And I would say that most hedge funds probably were leaning to the bearish side and were expecting a market fracas in the first week of August, because that's usually when it happens, when everybody's on vacation. So in essence, it's been pulled, about 2 weeks forward. And a point Mike made in his note yesterday, I'll make it for you, Mike, but jump in here, is it was also an expiry in the TI market. And all that matters. And so it is, kind of in the weeds, liquidity, technical stuff, but it is important because if treasuries behave that way, all the other markets have to respond.
Fantastic. Thank you, guys. It's a great warm up. Al Carnwright, we're so glad to have you. Welcome.
Thank you, Maynard. It's a pleasure being here. I've watched your sessions in the past, and they're wonderful, and you bring out some really cool ideas from a lot of diverse people. So I'm honored to be here. Well,
we're super pumped to talk to you. I mentioned it in the pregame. You've been doing it for 40 plus years. You've been helping companies. You have worked in energy companies, for energy companies, working across the spectrum and working across all the issues, and always working with management teams to help them solve their problems. Do you mind just updating people on your group, your team, the types of things that you're working on? Just tell us what's happening at the Carnwright Group, just to get us going.
Yeah, I'll be happy to. We're Houston-based. That's our headquarters. You'll see the odd about come out of me during the conversation. I grew up in Canada, and I'll come back to that in a minute. We have an office in London. We have an office in Abu Dhabi. We opened in London and Abu Dhabi to satisfy our international clients who we always worked from Houston, and it just became a geographic difficult proposition for us. So we've got 3 locations that we do business from. We work with everything from super majors, the largest in the world, down to small private companies, private equity backed, or small public companies. So pretty much the whole gambit. I started my career in 1979, early 80 in Canada with Pacific Petroleums. And I was there for about 11 years and then moved down to Houston in January of 91 to join a small little consulting firm called Sterling Consulting Group. And after about a year there, I did a leverage buyout with one of our other partners in the firm, and we built it up and we sold it to a public consulting firm, and then started over again as the Carnwright Group. So I've been doing this a long time. One of the things that when I was in Canada, the big consulting firms would come through and work for us, and I was always kind of a little bit appalled by the lack of content expertise and industry knowledge. They would very much play back what they heard from us, and that would be the solution they'd offer up. And I thought there had to be a better recipe. So that's why we started our own consulting firm focused on energy, built around energy experts that come out of the industry that happen to be good consultants. And then we spend a lot across the whole value chain, upstream, downstream, midstream, not so much in the power sector. But we do a lot of strategy work, as you mentioned. We help companies think through their portfolio, which, as you can imagine, has been a hot topic the last few years. What should the portfolio look like? We do a lot of work around changing cost structures and transformational activities. Some of it's supply chain related, but some of it's just getting the right cost structure and getting the right organization in place. We have a human capital practice that's all around change management, which in essence making stuff stick. If you're going to do a change, let's make sure it actually withstands the test of time. And then lately, as you would appreciate, energy transition has become real for everybody. And the equity markets and debt markets are clearly sending a strong signal to our industry that the way we did things in the past needed to evolve and needed to evolve faster. So we're working with a lot of our clients on the whole roadmap and what the company should look like in the future. And how do you get there without investing an inordinate amount of capital and still living within cash flow? And then the last area we spend a lot of time is digital transformation. We worked so hard on getting costs down that it was clear to us that the next step, if we were going to continue to evolve was through consolidation as well as applying digital to our industry. So it's something that we spend a lot of time on. That's basically what we do. We're a boutique consulting practice. There's about 50 of us or 60 of us around the world, I guess. And we pretty much do only energy, which makes us unique. And we're quite proud of the fact that we're focused on energy, and nobody's got to train us on how operations work. And so we kind of work from the operations all the way to the boardroom. So we're very fortunate to be able to do it for as long as we have, and we hope we can do it for another 30 or 40 years.
Well, see, that's why we're kindred spirits, that all energy all the time, feeling is just a good one. What, Al, I guess one question for you on cost. When you get pulled in to try to figure out costs, and you can do it with technology, and you can do it with processes, and you can do it with, I guess, in efficiency, so many ways. Well, tell us about cost cutting, and maybe put it a little bit in the context too of consolidation. We hear a lot about consolidation in today's world. Just what are we learning about good cost cutting and maybe, bad cost cutting that comes back to haunt you?
Yeah, that's a good question, Maynard. What our cost structure, just as an industry, got really out of whack with a volatile commodity environment. So it worked as long as things were moving up. I'd argue it worked poorly even then as commodity prices moving up. But when commodity price collapses, everybody says, well, our cost structure is too high. Well, it is. But at that point, it's really hard to bring it back to a low commodity price cost structure, because it's salaries and it's the basic way we do business now. So when we go into a company, we start almost from square zero. We look at almost a white paper on costs on the overhead front. We say, what does it really take to run a company? And we try to convince our clients that we should structure this thing for $40 oil. And if there's upside from that, how do we variabilize the cost structure so that we're not caught the next time we're at $40 oil trying to make transitionary cost reductions again. And then on the operating cost side, we spend a lot of time in the field. We look at how things are done. We look at processes. We look at supply chain. We look at automation. I'm shocked still by the cost structure that's out there in our industry. I'm so glad to see consolidation take place. It was long overdue. And for those of you that were in the industry in the mid 90s, I mean, there were two major drivers behind the majors consolidating. One was cost, and the second was we didn't have a good inventory to drill. So that's why you saw BP, Arco, Amoco come together, Exxon, Mobil, Texaco, Chevron, Conoco, Phillips, Total, Fina Health. That was all about getting our cost reset as an industry. And we did a fine job of it. But then we went through the next 20 years where we saw very little consolidation and only upward pressure on costs. And we got to 08, price collapse, needed to take a whack of costs. Unfortunately, we weren't down long enough to really get serious. And then 14 hit again, and then 2020. So I don't know, that looks like every 6 years to me. And that just, some was demand driven, like 08, the financial crisis. 14 was supply driven. And 2020, one would argue, was a combination of both, but largely demand falling away because of COVID. So we're really focused on our clients, zero basing their business, which is really hard to do. And setting the cost structure to afford $1 oil. And we hope we're in a super cycle of crude price and natural gas. And if it is, hallelujah, nobody ever went broke producing cash flow and returning to the shareholders.
One question for you as you're going through that. Well, first, my first observation is if I'm ever in like a Trivial Pursuit energy competition, I want you on my team. Because when you said Total, Fina, Elf, you just were rattling off all those names. But one serious question for you: the incentive structure that companies have, and you mentioned you work with everybody from private equity companies to state-owned companies to the majors. I'm always been struck, the PE company or the family-owned company, it comes directly out of your own pocket. Do you look at ways to incentivize employees to cut costs? Is that part of the discussion when you're looking at things?
It is, and it's become a lot more prevalent in the last year, I would say. Maynard, I got interviewed by another financial publication, and they tried to convince me that the incentive comp was too high in our industry. And I said, that's not the issue. The issue isn't the incentive comp, because if you look at the headline numbers, most of the stock that people were awarded was worth nothing anyway at the end of the day. And because we destroyed value during that time. But the KPIs and the metrics that we used to drive the executive comp was driven by what was expected of Wall Street at the time. The expectation now is different. And I don't care whether you're a public or a private company, cash flow now is king. Production growth for production's sake is not. And we're back to what I would what I consider much more rational drivers of the business, return on capital and IRR and all those metrics that are critical that we grew up with now are back. And that's fabulous. So with that, we've got to reset the compensation structure. So we're working with our clients on both short-term and longer-term compensation changes that reward you for real performance, tied to the new expectations of the business. So no, I think it's a natural thing that executive comp and compensation in general get reset. Clearly, during COVID, there was some salary reductions that were short-term, but that's not a long-term solution to our industry. So it has to happen on the variable piece and making sure that we're rewarded for what the expectations are. And I hope we never go back to growth just for growth. So far, we're being pretty dang diligent with the uptick in commodity price. And I'd like to think we're going to keep that diligence because frankly, I think the debt and equity market's going to demand it. But if they ever signal that risk is off and spend as much capital as you want, there will be some companies that will do that, and that will blow the whole incentive structure that we're putting in place out of the water. So that is a part of it. But really over the last year, and I'll give private equity a lot of credit. Private equity are saying there's got to be a better way for us to reward our management teams going forward. And how do we reset it so that they can make some money and still meet the strategic goals that we're going to set with them? So
you mentioned in the upfront, I'll stick with this cost, even though I was tempted to go off on some new directions. We'll completely kill this cost question. Because you mentioned digitalization up front. Are you optimistic that we're really finding ways to dramatically reduce our costs, permanently with technologies like that? Or how do you see the interaction of costs and digitalization?
I'd like to think we're a lot further along than we actually are, Maynard. We're, as an industry, for an industry that has learned how to drill horizontally for, a few miles and drill to the depths of the earth and fracking and everything else, we're really slow to take up technology that's basic digital technology that other industries have already adopted. So we're spending a lot of time with our clients around smart contracts that allow you to take out back office support and get paid faster. A lot of things around wellhead automation. And again, stuff we were doing before, but we really weren't doing anything with the data. So part of the digital work we're doing is there's a lot of data out there. What do we actually do with it? And how do we change our business decisions every day? And that requires process changes and also more visibility and better visibility to the data, which I think has led to a bunch of changes in our industry. But I'll be lying if I said we as an industry are where we need to be on digital. After all these years, I think when digital first came out 10 years ago, when you first started hearing about digital, we went out, we hired a bunch of data scientists, and we tried to boil the ocean. We said, we're going to digitize everything. And then the CEO looked up one day and said, oh, shoot, where's my payback on all my digital costs? And it was hard to see. So now we're taking a much more microscopic approach, which is the right one. Where can we truly add value through digital? We're seeing not only smart contracts or blockchain technology, we're seeing our artificial intelligence bring to bear, starting in refineries, but is now coming back to the wellhead. So things that again, other industries have been doing for a while that we're now starting to pick up on. So I'm really excited about the future, but I got to tell you, management is their own worst enemy still in some of this stuff in our industry.
So Al, thinking a little bit more about the macro questions, in the pregame, we talked a little bit about natural gas and how it's going to be with us for many years to come. What's your view on some of the strategic questions in boldface for the next few years, oil, gas, whatever the management team should be thinking about?
Colin, you just set me up to talk for a long time, so I'll apologize right now. Everybody has to put an energy transition strategy together. We have to decarbonize our own assets, and then we'll focus on methane. So there are some things that we as an industry need to do, and we need to do much better at. And so that expectation's been set. And as the industrial complex, then the focus will turn to the industrial complex, which is the carbon emitters in essence. And they're going to have to come up with solutions around what are they going to do to reduce their carbon. Some of that will lead to different feedstocks. Coal will likely be done in this country at some point for forever, which leads you to natural gas. Will become much more of a growing commodity. Oil, we're going to be in the oil industry for a long time. And that's in some cases a secret that nobody wants to talk about, is oil is going to be around for a very long time. And so as we decarbonize, the move to natural gas will take place. I actually think oil is going to be fairly flat from the demand standpoint, longer term. So if I'm running an oil company, I'm challenged with two things. I want to grow within my cash flow, and I also have to use some of that cash flow for the energy transition. Because if I don't move down the energy transition, I know I'm going to get penalized in the marketplace. And to be honest, it's the right thing to do. So I think it's going to be a really challenging time for our industry to balance cash flow and where we spend our money. So, if we're going to get serious about decarbonizing, then we need to start with the industrial complex. And that's fertilizing plants, that's cement factories, that's chemical facilities, that's refineries. And a lot of those are on the coast of the United States because for logical reasons, you need it exported. So you're talking California, you're talking New York, you're talking Texas, Louisiana. That's where the most of the decarbonization needs to take place. So I'm excited about the future. To me, oil and gas, we kind of went through the LNG stage, and that was exciting, and we're still growing LNG as a business globally. But now we have something else to focus on, and that is, is it hydrogen? Is it going to be wind? Is it going to be solar? Is it going to be what kind of carbon capture we're going to put in place? And it's kind of like the old debate. It's all of the above. We have room for that around the world. My fear, and I mentioned this to people in Europe, is we have 1.2 billion people telling the rest of the world how they should behave. And I have a real fear that we decarbonize 1.2 billion people. Well, there's 6 billion people just trying to live a better lifestyle, and they want the lowest cost feedstock and the lowest cost products. So I fear we're exporting as time goes on. The carbon challenge to other countries who are more than prepared to pick that up. Now, the European aristocrats that I talked to say, well, that's not our intention. But the reality is, if you bring in a carbon tax on imports into Europe, that will be the end game. Is you will be exporting a lot of that to other countries, and people say, well, everybody signed on to the Paris Accord. Signing on to the Paris Accord and actually living up to the commitments of the Paris Accord, I found are two totally different topics.
One question for you, Al. We see this as let's say you're a U.S. oil and gas company, and you see all these trends. There's so much to keep up with. You are, at the end of the day, an oil and gas company, so you got to focus on, your returns, your dividends, making your operations as low impact as possible. But your shareholders don't really want to see you blow a bunch of money on stuff that is not your expertise. At the same time, you do need to prepare for the future. What are you telling companies about, what kind of structures they should employ, what kind of people they should bring in, maybe how they should change the board, how they should participate in all this in ways that are high knowledge, but, low dollar? Like, how do you tell a company to prepare for the future that is, at the end of the day, an oil and gas company?
It's a great question, Maynard. We're working with 3 or 4, actually, 2 onshore U.S. companies and 2 offshore U.S. companies on that very topic. And there are some things that fit our oil and gas experience really well, engineering that being, and project management. The carbon capture space, CCU business, CCS business is a logical fit. Hydrogen, maybe longer term. Solar, I don't know. Anybody can put a solar plant out there. And wind, unless you're going to put it offshore, I'm not sure it fits our skills as well as the other. But so what we're working with our client on is some we're working with to turn it into a profit center that we'll actually do it for others. And I do think there's an opportunity for some first mover advantage in that space to try to build a business. As far as how do you structure it, these are all going to be special purpose vehicles because partnerships are going to be critical to the whole thing. We're going to need third-party capital. We're going to need third-party expertise. We're going to need maybe the emitter to be a partner in some of the work we're doing. So there'll be special purpose vehicles that are partly owned by the oil and gas company, partly owned by others. And I liken it to the old MLP. I think it's going to behave more like an MLP. If we can figure out how to unlock the code as a company that wants to turn it for profit, how do we get more assets just contributing to that model over time? So I'm actually excited about it. As far as the boards themselves, they will be slow to change just because they are. We're actually talking to a couple of companies about putting together advisory committees between management and the board to bring in the different views. These could be somebody out of Google. It could be one of the big emitters. It could be somebody that's big in carbon capture and got some real expertise internationally. So we're actually talking to our companies about maybe putting and again, it's advisory. The term advisory is important here. They're not taking on fiduciary responsibility, but it's a way to bring some different perspective and some different knowledge to the table. So we're quite excited about that as well.
Yeah, I think it's pretty interesting. If you look at sort of the energy transition, it seems like the European oil majors really kind of took off earlier than the U.S. majors. And without calling out any company in particular, what are the dynamics there? I mean, and what are the pitfalls of really moving too quickly as opposed to, say, the Exxons and Chevron, the domestic majors saying, we're just going to kind of step back, see how things unfold here. We're going to be part of that, but we're just not going to blow a lot of capital to get out there and be so woke, I guess, if you will, because what you've seen is the European majors, they really haven't got an uplift in their valuations by getting out there quickly and first. I mean, so how do you think about that, and how do you educate, or how do you consult these guys on that?
Yeah, I think scale is going to be critical, like anything, whether in our industry, oil and gas industry, it's major capital projects, it's being a big shale player in a particular basin. So scale is important. And I think that returns will get better with scale and better with technology. One thing we know as an industry, the more we do something, better off we're at doing it. So I'm excited by the future of it. Do I think the Europeans were out in front of the U.S. companies? Absolutely. BP started it 15 years ago and ended up writing off $7 billion. So Lord Brown was the first one to really drive towards it, and that didn't work out so good. The way they're approaching it now through wind and some of the carbon capture initiatives that are underway, I think those are fine projects. They're going to be 5 to 8% return businesses until you can build some scale. So you've clearly got to have a balance sheet that's going to allow you to do that. The problem with waiting too long, Exxon lived that, right? Exxon, in essence, had somebody say, well, you're not moving fast enough, so we need to change the board and change some members of the board. I think the U.S. companies are going to end up moving faster than they have in the last couple of years because it's going to be demanded of them. And frankly, I think if we can get to a 10% return business in the renewable space, given how much capital we've actually destroyed, the reality of it, and these are going to be 10% businesses for a long time. So think about LNG. You're going to almost build an annuity. How long is a wind farm going to last? How long is a solar farm going to last? A carbon capture business, very long time with maintenance. So I actually think the returns are going to look more like an LNG business. And as we start wrapping our minds around that, I think that will turn out to be an okay solution for us. But the U.S. onshore and the mid-tier companies and even the smallest companies are not going to be immune to having to put some capital into decarbonizing their own asset base that takes money away from where they would normally put it because capital is not accessible like it used to be. So we're definitely behind the U.S. or behind the Europeans, but I think that's okay. I'm not sure I wanted to be out. I wanted to be first in this space at all. I do want to watch and I want to follow. And to be honest, I want to invest in startups. I like what Chevron and others are doing that are investing in some of the smart technology companies that are trying to come up with the next breakthroughs. Because at the end of the day, it is darn hard to reinvent an industry from within. That goes for any industry, not just ours.
Okay, so Al, one question for you. I was thinking about your history. You have been a student of the energy game for 40 years, and we've all seen this pattern, which is we get in this mindset, which is everybody thinks a certain way, and then it doesn't work that way. Like the U.S. is running out of natural gas, we've got to have regas facilities, and then lo and behold, I mean, there's so many of these things over time that we were sure of, and then it didn't work out that way. When you kind of think about how things might work out over the next 10 or 20 years, what's a surprise thing that you wonder about? Like, is it, sometimes we talk about nuclear making a comeback. we've had some fascinating visits with like the Salk guys who have these unique nature-based solutions. Like, what's a wild card? What's a thing that you think we might ought to be thinking about a little bit more?
That's a great question. I think we always underestimate technology, Maynard. We always underestimate what we can do by pushing technology in different directions. And we're always surprised with, the reason we found so much natural gas is there was so much natural gas there to find when we had horizontal drilling and fracking became mainstream. So it seemed like it happened overnight, but it took us a few years to get there. So what I see in the future, I think there's going to be a lot more geothermal. I think there's a huge play in geothermal on a global basis. I really like the carbon capture space because, again, I think it's an elegant way to solve the carbon problem in this country and in other parts of the world. And I think it fits our skill sets very well. So nuclear and possibly, but I think they're going to be Bill Gates is clearly working on some of these micro nuclear plants that maybe they'll serve a purpose. I'd like to think they will because it's the cleanest opportunity we have. And there's other technology that now is looking at reusing old nuclear rods for other purposes. So again, I think the more startups that are trying to solve this problem, the better off we're going to be. And I can't pick which ones are going to win, but I want to be in as many of those companies as I possibly can as an investor, because I think they're smart people that aren't encumbered by how we did things in the past. They're trying to solve a problem with a much more youthful mind generally, than certainly I have, to try to figure out how do we get to an energy transition faster.
And Al, is that startup world? I think we tend to think of this. I'll confess, maybe I think of it this way: is that the U.S. is really good at that and has tons of them. But you're a global guy. Do you see startups all over the world? Is there just what does the startup world look like from your perspective?
Oh, I think still the U.S. owns that, and I think Houston is quickly becoming a strong epicenter for technology startups around the energy transition. And then you got Austin, obviously, you got the West Coast, you got Miami now. But I think if you look at the ecosystem of...
Hold on, Al. I love Miami. Can we go to Miami to see energy startups? Is that what you just said?
Yeah, that's what I said. I love Miami too. And if California and New York keep putting policies in place, Miami and Texas will be the recipients of that policy. And that's why we're seeing so many new startups move to Miami and Austin and Houston. But Houston at least is an epicenter for the oil and gas industry. So I'm involved in a lot of the ecosystem here in the Houston area and the startups, and I'm just fascinated by some of the ideas that people are pursuing. And like any startup, 1 in 10 might make it. But boy, if they make it, they're going to make it big.
One last question. We really appreciate you joining us here, Albert. And you said it, right? Startups, they just think different. Do you spend much time with corporates trying to show them how to innovate? Because this was something here recently I noticed, usually in a corporation, you just, people become a little bit too corporate. They get a little bit too stiff and they stop wanting to brainstorm and just throw it out there and, do the things that startups do. Do you ever spend time with corporates trying to get them to, I don't even know what the word is, loosen up a little bit, I guess is what I'm saying.
I think it's a great question. I think corporates are reasonably good at innovating in what they know. But if you push a corporate beyond, like in the energy transition, terrible. They're out of their comfort zone. And I'll give you an example. If it takes 120 days to get an NDA signed with a company, how are you ever going to move fast enough to compete?
That's funny.
And we're still dealing with that, 120 days to get an NDA signed. So Maybe that's just us, but I don't think it is. So I think the like most breakthroughs in technology, it's going to come through, I think, new startups and new investment vehicles. And that's not to say the majors and each of us individually can't play a role, because there's going to be need for capital and need for good ideas and need for engineering and project management and all the stuff that a major does and an oil company does. So as I said, I'm excited about the future, but I got to tell you, I'm the thought of a breakthrough coming from the bigger the company gets, it's hard to see. It's very difficult for them.
Al, I just figured out there's now my law friends are not going to like this comment, but startups, one distinguishing feature is they usually don't have a law department in the company. So I don't know if this is a thing to watch.
Well, we invest in a bunch of startups through our joint venture arm, our investment arm, and we don't use that as a criteria, but I might have to add that as a criteria, Maynard.
You watch. Colin will be back next week with a chart, which is a number of lawyers and patents. He'll I don't know, maybe those are correlated. Inversely, I'm not sure.
Well, I don't want to think over the last few years, I wish I would have been a K&E lawyer or restructuring lawyer, because that's pretty good business these last few years. Well,
isn't it, with all due respect for our restructuring friends all over the lower 48, it's nice to not be talking as much about restructuring.
I got that.
Well, Al, the old expression is time flies when you're having fun. Time flew here today. We loved your comments. The one about a billion of us shouldn't be telling the other 6 billion what to do. That might be our tagline for today.
Thank you very much, guys. I really appreciate the opportunity, and I'm honored to be here with you. It's a lot of fun.
Well, I know we're going to get a lot of quote viewer mail. Say hi to my friend Al. So we'll be passing those on when they come in. I know they're coming. Thanks, guys. Appreciate it. Have a good day. Thanks for joining us. See you soon, Al. Bye. Bye.